Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's video insight. Before we get on to today's subject, let me respond to the comments that have been made about my article concerning superannuation. Many of you have responded by saying that under current legislation and current tax rates, superannuation is very attractive. Please remember that the whole point of the column was to suggest that historically legislation has changed, and in the future legislation is likely to change again. I'm proposing the idea that because superannuation was designed by baby boomers for baby boomers, that when the benefits for baby boomers have passed, legislation may be adverse towards superannuation and those who are much younger. And that was the subject of the column. I simply want you to consider the possibility that legislation could change and adversely affect those who are maximising their contributions now, but are under the age of 50 and under the age of 40. Okay, today's subject is slightly different. I left you last week with the idea that the market appears to be fairly valued for high quality companies. We have as many companies that are good quality that are slightly over their valuations as we do companies that are slightly under their valuations. What I want to do today is leave you with some companies to go and investigate further. These are companies that we currently believe and Scaffold believes represent value, are high quality, but of course their prospects may change, particularly now that we're in reporting season. So what I did was a scan, and I scanned for companies that were A1, A2 or A3 or B1 companies, so fairly high quality companies. There were 95 of those in the Australian universe. I then looked for, and trading at a discount to intrinsic value. I then looked for companies that had less than 30% debt to equity, and in fact the vast majority of them had net cash. I then looked for companies that were generating or had generated a return on equity of greater than 20% in the last reporting period, and I wanted companies whose earnings per share were forecast to grow over the next 2 years. The companies that came up on this list are interesting, and I'm going to list some of them now. This is not a recommendation for you to go and buy, simply a suggestion for where to go and dig. So here is a list of companies. And one of the things that you'll notice is quite a few of them are mining services businesses. Now you know our view on mining services and our view on the iron ore price. We believe that this year the iron ore price could reach new lows. So far we've been wrong on that call. So bear that in mind as I give you this list of companies. Hawkley Oil and Gas is one, Forge is another, Macca, Mastermine, Deckmill and Lycopodium, all of those businesses are mining services businesses, and it's interesting that out of the universe of stocks, those that meet the criteria that I've given you, that we used as our filter to find them, that many are mining services. Those that are not mining services include Cabcharge, JB Hi-Fi and Flight Centre, and one more that's in the middle is Codan. So there's a list of companies for you to go and research. I look forward to talking to you again next week, and continue to follow us on Facebook and Twitter. See you again.